So you have a health savings account. Could you be leaving money on the table? Well, welcome to part one of a three-part series on health savings accounts. HSAs are available for those with high deductible healthcare plans. Just what the IRS defines as a high deductible healthcare plan. The synopsis is if you have self-only coverage for health, the deductible must be at least $1,650 in 2025. Same year, but for family coverage, your deductible should be at least $3,300. HSAs allow you to set money aside for qualified medical expenses tax-free. For example, if you contribute $1,000 to an HSA, it comes from your gross earnings, not your net earnings. So none of that money is taxed up front, nor is it taxed when you use it to pay for qualified medical expenses. Now, what are qualified medical expenses? Now, according to the IRS, qualified medical expenses are those expenses that would generally qualify for the medical and dental expenses deduction. These are explained in publication 502, Medical and Dental Expenses. Now, in 2005, the contribution limit to an HSA is $4,300 for those with single coverage, and for family coverage, your maximum contribution can be $8,550. Now, what kind of tax savings is that? For an individual or family within the 22% tax bracket, that's roughly $946 in yearly savings and $1,881 for yearly savings for a family. These contribution limits are adjusted for inflation year after year, but you should still consider the potential tax savings over, let's say, 20 years if you have one of these accounts. We're talking close to $20,000 for single coverage holders over 20 years. And that's just a conservative estimate. Some people might confuse HSAs for flexible spending accounts, but it is important to know that the two are not the same. They are very similar. Flexible spending accounts, or FSAs as some people call them, must be used year to year or used up year to year. You don't have to use the account up every single year like an FSA. It will continue to roll over year after year. Now, here's an insider tip. If you save your receipts and you decide not to seek reimbursement in the year that you pay for those medical expenses, you can still seek reimbursement years down the road for those medical expenses. So there is some leeway there when it comes to the planning process and planning for your financials. So the tips that you need to take from this video: save your medical receipts. Do not throw away those medical receipts after the year is done. You can seek reimbursement years down the road for those medical expenses. It doesn't have to be in the same year. Now, if possible, contribute the maximum amount to this HSA. Your future self will thank you. If you don't have to worry about using up or losing your contributions. They roll over year after year. Next up, pay for expenses with cash or credit out of pocket, essentially. And then take control over when you want to get reimbursed by choosing when to submit for those HSA distributions. If you need that reimbursement at a certain time, you'll thank yourself for saving those receipts years ago or months ago so that you can seek reimbursement for those expenses. This maximizes the earning potential of the account, and we'll get into that in part two. So we'll see you soon.